Imagine an investment philosophy so powerful. It's even been called the eighth wonder of the world by some really sharp minds in finance. We're not talking about, get-rich-quick schemes or anything like that. It's more disciplined approach, building lasting wealth that kind of works quietly, almost invisibly over time. Today, we're taking a deep dive into the world of quality investing and really unlocking the secrets of compounding.
Yeah, and for this deep dive, our sources, they come straight from this comprehensive ebook, The Best of Compounding Quality. It's absolutely packed with insights, practical frameworks, and, wisdom distilled from legendary investors. It's designed to help you shortcut your way to being genuinely well-informed on this crucial topic.
So our mission today is really to pull out the most important nuggets, give you those real aha moments, and connect the dots so you can understand what truly defines a quality company and how that magic of compounding can actually work powerfully for you.
Okay, so let's unpack this a bit. We hear about all sorts of investment strategies, value, growth, but what exactly is quality investing? How does it, stand apart from the others?
Well, at its heart, quality investing focuses on identifying these quality companies. Sometimes they're called compounders, which is a great name for them. They're businesses that consistently grow their free cash flow exponentially year after year. And this growth, it isn't just luck. It comes from a combination of really favorable characteristics.
Yeah.
The real beauty here, I think, is once you've done your homework, really dug in and picked well, you're not constantly churning your portfolio. You basically buy, hold, and sort of let the company do the heavy lifting for you.
Right. So it's quite different from, say, value investing. Exactly. Value investing often involves buying something undervalued, selling when it hits what you think is its intrinsic value, and then, starting the search all over again. With quality investing, if you find a truly great company and buy it at a fair price, the whole philosophy encourages you to actually never sell it.
Wow, never sell. That's a big commitment. So it's about finding businesses that can just keep producing fantastic results for decades.
Mm-hmm.
Can you give us a couple of examples, companies that really show this kind of compounding power of a long haul?
Oh, absolutely. The sources point to some incredible long-term compounders. Think about IDEX X Laboratories. They've seen something like a 21.2% compound annual growth rate since 1991. That's huge. Or Microsoft, even longer term, since 1986, delivering 25.9% annually. These aren't companies you just trade in and out of. They're the kind you sort of, marry, financially speaking. You let time do the heavy lifting as their business keeps expanding.
That really emphasizes the long game, doesn't it? But,
Yeah.
with so much noise in the market, day-to-day fluctuations, what are some simple guiding principles, things that have helped the legends identify and, maybe more importantly, stick with these kinds of investments?
It's actually quite remarkable how the investing crates simplify this. You've got Terry Smith, a really well-known quality investor. He boils it down to just three things. He says, 1, buy good companies. 2, don't overpay. 3, do nothing. Simple, but powerful.
Do nothing. That sounds easy, but I bet it's the hardest part.
It often is. And then there's Chuck Akers' three-legged stool idea. It's another great framework he suggests looking for. 1, good, very profitable businesses with a wide moat. We'll talk about moats. 2, with capable and integer management, people you trust. 3, which can reinvest a lot of free cash flow in organic growth. These frameworks really cut through all the complexity and focus on what truly drives long-term value.
Okay, that do nothing part or the letting it work for you idea,
Yeah.
it sounds almost too simple, but it's powered by something really amazing, compounding. What exactly makes compounding so incredibly powerful? Why is it the eighth wonder?
Well, it gets called the eighth wonder of the world for a very good reason. It's that process where your earnings start generating their own earnings. It leads to exponential growth. It starts off really slow, like a tiny snowball rolling down a gentle hill. But the longer you keep it rolling, the bigger and faster it gets. And honestly, most people's brains, we just aren't wired to intuitively grasp exponential growth. We tend to think linearly.
Yeah, I've heard some pretty wild examples of compounding. Can you maybe give us one that really makes that exponential growth click, something memorable?
Yeah, there's a classic one. Imagine you have a choice.
Yeah.
You can take $1 million in cash right now.
Or
You can take a single penny that doubles in value every single day for a month, say 30 days. Most people, understandably, jump at the $1 million.
I probably would.
Right. But think about the penny. After 5 days, it's only worth 16 cents. After 10 days, it's still just $5.12. Seems trivial. It actually takes until day 27 for that doubling penny to finally pass the $1 million mark. But by the end of day 30, That single penny is worth over $10.7 million.
Wow, over $10 million from a penny.
Exactly. It's a fantastic illustration of why patience and a really long-term perspective are just crucial. You have to give compounding the time it needs to work its magic.
Those numbers are genuinely mind-boggling. That slow start suddenly exploding like that.
Yeah.
It's incredible. So how can we, the average investor, harness this magic in our own investing journeys? What are those practical things we should be focusing on?
I think the single biggest takeaway is simply to start early. The sooner you begin investing, the more time compounding has to work for you. Those early years are incredibly powerful. Think about the Ben versus Joey example from the source material. Ben starts investing at age 21. He puts in $200 a month, but only for 9 years. Then he stops completely. Joey starts later at age 30. He also invests $200 a month, but he does it for 37 years, way longer.
Right.
But when they both reach age 67, Ben, who actually contributed only about a quarter of the total money Joey put in, Ben ends up with almost twice as much money. We're talking $2.1 million for Ben versus $1.2 million for Joey.
That's incredible. So those first few years made all the difference, even though he stopped.
Massively. It just shows how critical time in the market is.
Okay, but like we said, for a lot of people that do nothing part, just sitting tight, that's the hardest bit. What's the biggest, maybe psychological hurdle investors face when they're trying to let compounding work? And how can we actively fight against that urge to tinker?
Oh, that's such a human challenge, isn't it? Our brains, they really crave action, immediate results, immediate gratification. So the biggest hurdle is definitely impatience and the constant temptation to react to every little bit of market news, every dip, every surge. Like Charlie Munger wisely put it, the first rule of compounding is to never interrupt it unnecessarily.
Never interrupt it.
Exactly. And we see this play out in another example, Olivier versus Emma. Emma, like Olivier, starts investing $200 a month at age 21. Good start. But Emma stops investing when she turns 30, maybe life gets in the way, and only starts again at age 40, so a 10-year gap. By age 67, Emma ends up with about $1.1 million. Olivier, who never stopped, he has $3.3 million. Emma's 10-year pause cost her 2/3 of the potential wealth. A pause, even one that feels temporary, can have a truly massive impact because you miss those crucial years where the growth really starts accelerating exponentially.
Wow. So overcoming it means really believing in the companies you own and having the discipline to just tune out the noise.
That's a huge part of it. Deep conviction and discipline.
All right, so we totally get the why compounding is essential. It's the engine. But the how for quality investing is finding those amazing compounding machines. What exactly should we be looking for in these companies? What are the key characteristics? What makes them tick differently?
Right. The source material lays out about 7 distinct characteristics that really define a quality company, a true compounding machine. The first one, and maybe the most famous, is having a wide moat. A strong competitive advantage. Warren Buffett has that great quote, a good business is like a strong castle with a deep moat around it. I want sharks in the moat. I want it untouchable. It's basically some kind of structural advantage that stops competitors from easily coming in and eating away at their profits.
Okay, sharks in the moat. I like
Yeah.
that. So how do these moats actually show up in the real world? What are some of the powerful types we should look for?
Well, there are generally 5 types discussed, but let's focus on a few that are particularly powerful for a quality investor. First, network effects. These are incredibly potent. Think about Visa or Google. The more people use the service, the more valuable it becomes for everyone. That's hard to replicate.
Right, creates a virtuous cycle.
Exactly. Then you have switching costs. Think about a company like Salesforce. Once a business is using their system, it's just a massive hassle and expense to switch to a competitor. That creates really sticky recurring revenue. And third, strong intangible assets. This could be powerful brands like Coca-Cola or essential patents. Again, very hard for others to copy. These types of moats often signal truly defensible businesses. They usually give the company pricing power and lead to high returns on capital. A key financial indicator we look for is a consistent return on invested capital, or ROIC, that's significantly higher than its weighted average cost of capital, the WACC, over a long period.
Okay, you just mentioned WACC there, weighted average cost of capital. Now, many listeners might know ROIC, but maybe less familiar with WACC. Can you quickly break down what WACC is just at a high level and why comparing ROIC to it is such a key insight for quality?
Absolutely, great question. Think of WACC as the company's minimum required return on its investments. It's basically the average cost of all the money the company uses to operate, whether that money comes from borrowing debt or issuing stock equity. So if a company's ROIC, the actual return it generates on the capital it invests, is consistently higher than its WACC, it means it's not just growing. It's creating real economic value for shareholders. It's earning more than its capital cost.
Got it. So it's like earning a higher interest rate on your savings than you're paying on your loans, a fundamental sign of health.
Precisely. It's a core sign of a truly profitable, well-managed business.
Makes perfect sense. Okay, so beyond that strong moat, what's characteristic number 2?
Second, we look for integer management, sometimes called skin in the game. This really means that management's interests are deeply aligned with yours as the investor. They treat the company's money like it's their own money. There's a quote from Martin Sosnoff in the source. If management and the board have no meaningful stake in the company, at least 10 to 20% of the stock throw away the proxy and look elsewhere.
So significant ownership matters.
It often does. But it's also about mindset. You're looking for stewards, true custodians of the business, not just hired hands maximizing their own short-term pay. You watch out for things like excessive share-based compensation that isn't tied to performance, or maybe a history of really value-destroying acquisitions. Those are red flags. Interestingly, a Credit Suisse study found that family-owned businesses, on average, tend to outperform non-family businesses by about 3.6% annually. It suggests that long-term owners' mindset really pays off.
That's a fascinating statistic. Okay, what about number 3 on the list?
Third is low capital intensity. This is really important. These are businesses that need very little capital, very little cash reinvested, just to maintain their current operations and also to fund future growth. Think of it like this. If you own, say, a software company versus a heavy manufacturing plant, the software company probably needs much less ongoing investment in big machinery just to keep running and growing. A business with low capital expenditures, or CapEx, can take most of its profits and either return them to shareholders or reinvest them for more growth rather than just tread water maintaining the existing assets.
So you're looking for specific numbers here.
Yeah, ideally you look for metrics like CapEx to sales being less than 5% and CapEx to operational cash flow under 15%. Companies like Automatic Data Processing, ADP, Domino's Pizza, BlackRock, they fit this mold really well. They are just fantastic cash flow generating machines.
Okay, so if they're generating all this cash with low capital needs, what do these compounding machines actually do with that cash? Which leads us nicely to the next point, right?
Exactly. The fourth characteristic is good capital allocation. This is all about how management smartly, effectively uses the free cash flow the business generates. The best use generally is reinvesting it right back into the business for strong organic growth, ideally aiming for more than 7% organic growth per year. Other options include making smart acquisitions, buying back shares, or paying dividends. Dividends are often considered the least efficient for pure growth, but they have their place. What you really want to see as evidence of good allocation is a high and consistent ROIC. Remember that metric?
Right.
Preferably above 20%. Companies like Sherwin-Williams or Adobe are often cited here.
Right, so it's not just making the money, it's what they do with it. Okay, beyond how they handle capital, what about the raw profitability numbers?
Yeah.
How do we spot a company just gushing cash?
Yep. Fifth is high profitability. We're really talking about how much of the company's sales actually turn into cold, hard cash. We look for a free cash flow, or FCF, margin of at least 15% and ideally, over 20%. That's a strong sign. Also, you want to see a high percentage, maybe over 90%, of their reported earnings actually converting into free cash flow. The source puts it bluntly. Earnings are an opinion, cash is a fact. Because FCF is just much harder to manipulate with accounting tricks than reported net income. Think about Visa, for example. Their FCF margin is around 60%. Compare that to, say, General Electric in the past at maybe 2.9%. It highlights that robust cash generation we're looking for.
60%, that's incredible. Okay, what about growth itself? Should we be chasing the absolute newest, fastest growing thing, the next big disruptor?
Well, that leads to number 6, attractive historical growth. And this is actually quite critical. The philosophy here isn't about trying to predict the next big thing. Instead, you want to invest in companies that have already proven they can win. They've already succeeded. A good indicator is looking for businesses that have generated, say, at least a 15% compound annual growth rate, CAGR, for their shareholders since they went public. It's evidence of sustained success, not just hype or potential.
Okay, proven winners. And finally, there's a forward-looking aspect too, something about the environment they operate in.
Yes, exactly. 7th is being part of a secular trend, which signals a bright outlook for the future. You know the saying, the trend is your friend? It really holds true in investing. Putting your money into companies that operate within strongly growing markets, it gives you this sort of tailwind. It's like having the wind in your sails as an investor. Think about big, long-term themes. Urbanization benefiting companies like Cone Elevators or cybersecurity boosting Fortinet, the rise of passive investing helping BlackRock, or even the global challenge of obesity driving growth for Novo Nordisk. You want that underlying market growth, aiming for organic revenue growth for the company of at least 7% per year, ideally.
Okay, wow. That's a comprehensive checklist. Moat, management, low capital needs, smart allocation, high profitability, proven growth, and a tailwind. So we've identified what makes a company quality. Fantastic. But even the best company in the world isn't necessarily a great investment if you pay way too much for it, right? How do we approach valuation for these compounding machines, especially since they often look expensive based on simple metrics?
That's the million-dollar question, isn't it? Warren Buffett famously said, price is what you pay, value is what you get. And for quality investors, generally, the quality of the business itself is more important than getting a rock-bottom price. But you're right, you still don't want to wildly overpay. Benjamin Graham talked about the market being like a voting machine in the short term, driven by emotion, popularity, sentiment. But in the long run, he said, it's a weighing machine. It reflects the underlying fundamentals, the intrinsic value of the business. And over that long run, stock prices do tend to follow the underlying performance, the earnings, and cash flows of the company.
Okay, that makes sense. So is there a preferred valuation metric for quality investors? That we hear about PE ratios all the time, but is that the best tool here?
Well, metrics like the price to earnings, PE ratio, price to book, PB/PEG ratio,
Yeah.
they all exist and have their uses. But our source material and many quality investors tend to prefer looking at the free cash flow yield. The reason is, as we discussed, free cash flow is generally seen as more robust, more reliable, harder to manipulate than reported earnings. It gives you a clearer picture of the actual cash the business is generating for its owners.
And it avoids the trap of just buying something because it looks cheap on a PE basis.
Exactly. Just because something has a low PE doesn't automatically make it good value. It could be cheap for a very good reason, like it's a declining business. The source gives a really great example comparing S&P Global and General Electric back in 2010. S&P Global traded at a PE of around 19.3, which might have seemed a bit pricey, but its average ROIC since then has been exceptional, like 27.4%. General Electric, on the other hand, looked cheaper with a PE around 15.3. But its average ROIC was dismal, only about 2.2%. And guess what? S&P Global dramatically outperformed GE over the following decade. It really shows that paying a higher multiple can absolutely be justified if the underlying company is fundamentally healthier and has that superior compounding power.
That's a powerful comparison. Quality trumps cheapness in the long run. Okay, so this brings us to a really interesting tool mentioned in the sources, the reverse DCF, or reverse discounted cash flow. It sounds complicated, maybe something only finance pros use. Can you simplify how we as individual investors can use this idea? How does it help us figure out if a quality stock is fairly priced, even if it looks expensive?
Yeah, it sounds intimidating, but the concept is actually much more intuitive than a traditional DCF, I think. See, instead of you trying to predict a company's exact future free cash flow growth for the next 10 years, then discounting it back to get a single fair value number, which is really hard to do accurately, you flip it around. You start with the current stock price, and you ask, okay, given this price, what growth rate in free cash flow is the market already assuming or pricing in for this company to justify this stock price and give me my desired return?
Ah, okay. So you work backwards from the price.
Exactly. You work backwards. And then the crucial step is you decide, based on all your research, the moat, the management, the trends we talked about, whether you think that growth rate the market is expecting is realistic. Is it too high? Is it too low? Or is it about right? It transforms valuation from trying to be a fortune teller into critically evaluating the market's expectations against your own informed judgment about the company's prospects.
Can you give a quick example?
Sure. Let's say a company trades at $400 per share, and it currently generates $10 in free cash flow per share. And let's say you want at least a 10% annual return on your investment. Using a reverse DCF calculator, you can find simple ones online, you might find that the market is implying about a 7.5% annual growth rate in free cash flow per share forever to justify that $400 price and give you that 10% return. Now, the question for you is, based on everything you know about this company, do you believe it can realistically grow its free cash flow per share faster than 7.5% per year over the long term? If you think, yeah, absolutely, given their moat and market position, they can probably do 9 or 10%, then the stock might actually be undervalued for you relative to your required return.
Got it. So it's less about finding an exact price and more about assessing the plausibility of the growth assumptions baked into the current price.
Precisely. It helps you understand the hurdle rate the company needs to clear to be a good investment at today's price. Professionals use this kind of thinking all the time to evaluate if, say, Apple or Alphabet can actually meet the market's high expectations for future FCF growth.
That's really helpful. Okay, we've covered the what of quality investing, the how of finding these companies, and how much regarding valuation. Now, let's maybe wrap up with some timeless wisdom from the titans of investing, just reinforcing these key principles of quality and compounding.
Yeah, it's amazing how consistently the great investors echo these core themes. You look at Warren Buffett, for instance. He distills so much. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. That's quality over price right there. He also has that famous line, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. That's the long-term compounding mindset.
Absolutely essential.
Then there's his partner, Charlie Munger, who adds that crucial element of patience. The big money is not in buying or selling, but in the waiting, just letting it happen. And Peter Lynch, famous for managing the Magellan Fund, he always emphasized, let your winners run, don't cut your flowers to water the weeds. And he also said, time is on your side when you own stocks of great companies. These 3 quotes alone really capture the essence, don't they? Focus relentlessly on the quality of the business, have the patience to let compounding work its magic, and crucially, have the discipline not to interrupt that process unnecessarily.
It really brings it all together. This deep dive has definitely shown us that building real, lasting wealth through quality investing and compounding. Well, it isn't about chasing the next hot tip or trying to perfectly time the market swings. It's much more about having a clear philosophy, understanding those key company characteristics we talked about, doing diligent analysis, and maybe above all, having that unwavering patience and discipline.
Absolutely. Just remember, compounding is the powerful engine, the magic, if you will, but quality is the fuel for that engine. So look for those companies with the strong moats, the integer management you trust, low capital intensity, so they gush cash, and excellent capital allocation skills. And ideally, they're operating within strong secular tailwinds. Value them fairly using tools like the reverse DCF idea to check market expectations. And then, as Terry Smith so simply put it, often the best course is to just do nothing and let time perform its remarkable work for you.
A fantastic summary. So perhaps the final thought for everyone listening is this. As you look at the investment landscape today, what hidden compounding machines might actually be hiding in plain sight, just waiting for your discerning eye and, crucially, your long-term commitment?